We know how busy you are, and we really appreciate you taking the time out of your day to spend the next hour with us. We have an exciting webinar in store, and we hope you find it insightful and interesting. I'm David Ronald. I'm the Director of Product Marketing at TigerGraph, and I had the great pleasure of introducing Heather Adams, Managing Director, Resilience, Risk and Trust at Accenture. Heather specializes in keeping institutions safe, which isn't a bad thing. She helps clients improve their fraud and financial crimes capabilities across risk, compliance, operations, data, and technology functions. Over her 21 years with Accenture, she has worked with many of the world's largest and most complex financial services organizations to deliver transformational change across policy, process, organization, technology, data, and analytics. Heather helps her clients leverage new technologies and techniques to fight financial crime and better manage risk while also driving efficiencies. Welcome, Heather.
Thank you. Thanks for having me. It's a pleasure to be here.
And I'm also delighted to introduce Chris George, Director of EMEA Channel Alliances and Partnerships at TigerGraph, so therefore a colleague of mine. Chris has worked in the data and analytics industry for 14 years and joined TigerGraph to build and run our partnership programs and network across EMEA. Chris has worked for both software vendors and consultancy companies across the industry and has worked with customers to deliver data insight projects across most specialties, from financial reporting to marketing analytics and everything in between. Welcome, Chris.
Thanks, David.
So before we get started, the usual housekeeping issues. Phones are muted, but please don't take that as any indication that we don't want to hear from you. That's standard procedure, standard policy with Zoom, as everybody knows. But we do want to hear from you. We'd love to make this as interactive as possible. So feel free to submit your questions, and you can do that, as everyone knows by now, given all the gazillions of Zoom calls we've been on the past year plus, you do that through the Q&A button. Maybe more relevant, this webinar is being recorded and we will upload it to our website very shortly after it ends. My colleagues in marketing are very quick and can usually get the webinar uploaded within a couple of hours. So, keep an eye open for that. And we'll also email it to you along with the slides and any other relevant documentation or whatnot. So keep an eye on your inbox for that. And last but not least, if you do have any issues with Zoom, reach out to us using the chat button, and we'll do our best to resolve those issues in a timely manner. So with that, so today's discussion is going to be a panel discussion. And so, we'll have a few slides to just help move things along, but it's largely driven by, our Q&A for Chris and for Heather. So Heather, why don't we start with you? And, share with us some of the challenges facing financial organizations in fighting anti-money laundering these days.
Thanks. So I've tried to, in a sort of visual way, map out some of the key things. And I really think that it's a combination of internal challenges and external pressures. External pressures are probably clear to everyone. They are one from customers who, in essence, want to be protected from a fraud and scams perspective, but really don't want to be held up by any controls that may be needed to help the bank prevent money laundering. No one wants their bank to be in the press for being involved in any money laundering scandals, but we all want to open our accounts as smoothly as possible, complete our transactions as quickly as possible, and not have any blockers on any payments that we're trying to make. So the smoothness of the digital journey and experience is super important to customers, and they need to feel like it's safe and secure, but honestly, by the way that is unonerous as possible. From governments and regulators, keeping customers safe is paramount, as well as keeping the financial system safe from fraudsters, scammers, money launderers, and people who are subject to sanctions. So there's a huge amount of expectations on financial services organizations to really look across the customer relationships they have, the relationships in the network, and in the transactions that are being made through their institution and their payments facilities, to make sure that they're not facilitating any payments to any sanctioned parties, money launderers, terrorist financiers, or any fraudsters. So that's a big liability, and something that has a lot of regulation and differences in regulatory requirements around it across the globe. So big international organizations really suffer in this space. Those who have multiple different business or product lines, or those that operate in multiple geographies, really need to think carefully about how they meet all those obligations. And frankly, internally, what that then often leads to is inconsistent policies and procedures that have cropped up across the different business units and the different geographies, a very static view of risk, very fragmented processes. And then if we think about the sort of technologies that they're using for monitoring and things like that, they're often quite rules-based, quite static. They lead to a lot of false positives. And that in turn just drives a lot of operational effort. So very sort of manual investigations, duplicated effort across teams, and challenges really in terms of traceability of data and accountability and things like that. So pretty tricky landscape.
Very interesting indeed. Thank you for that. How has this field changed in the past 5 years, and how do you see it changing in the next 5 years?
Yeah, so it's one, I think, that has changed a lot, but it feels like the pace of change is ever picking up in terms of its rapidity. Would you mind moving on to the next slide?
Nope, love to.
So I guess in terms of where we've got to today, I think it's been all about building out those different controls and trying to establish a control framework across the different geographies, across the different product areas, to be able to identify financial crime risks. So I would say banks have been really active since 2002, probably, in terms of starting to care about this. But it's really picked up the pace probably in the last 5 years in terms of really making sure that there's full coverage across all transactions, all payments, all customers. But it has been done in quite a reactive way, and leading to those challenges that I highlighted before. So where I see people going in the next 5 years is really on this journey to be a lot more rule-based, a lot more automated, a lot more using a lot more analytics and modeling and things to really help reinforce and drive through consistent policies and standards, to take a much more risk-based approach, to really use data, whether it be internal data or external data, and drive that through into the controls that you have. So drive it through into transaction monitoring, into screening. To make that effective from a risk perspective, there's a need to set enterprise-wide risk tolerances, or to at least have a framework for risk tolerances that is enterprise-wide, even if perhaps there's different risk appetites in different geographies or in different product lines, for example. But there needs to be a way of doing that, and to take it down to the level of risk tolerances, because that's where you can take a more automated approach, but still control and be able to demonstrate it's within the boundaries of what you desire from a risk perspective. Mm-hmm. And then very much from an operational perspective, the advantage of this increased automation and a more data-driven based approach gives you is we can get rid of a lot of the wasted effort of today, and we can refocus the effort and the intelligence in actual true investigation of cases that are really unusual or really interesting, rather than those that are just, it's a volume, needle in haystack kind of activity. Mm-hmm. And so in the near state, I definitely see most organizations starting to evolve some of those solutions. And then I see an ongoing evolution in terms of the future state that people are working towards, where it gets ever further streamlined, get ever better at using pattern-based rule detection, looking at a risk-based approach for screening, for monitoring, and it becomes more connected. So at the moment, you have this fragmentation between the different controls, which is what I'm sort of trying to illustrate with like the verticals in the middle picture. Is today, a lot of the automation is happening within KYC or within monitoring or within screening. In future, it will be much more about what's the data-driven approach to determine risk and determine if an investigation is required. And the indicators could come from adverse media screening, they could come from sanctions monitoring, they could come from transaction monitoring, and it will all come together in a much more streamlined platform way of looking at risk and taking action.
Fascinating.
That's my prediction anyway. That might take a bit longer than 5 years, so that future.
That's fantastic. And COVID, how's the COVID pandemic affected this, this field of anti-money laundering?
Yeah, so I think, the effects of COVID have been varied. On the one hand, I think there has been new criminal activity and sort of new typologies that we need to look for from a risk perspective. I think there's been a renewed focus on people attempting to launder money through cryptocurrencies and other virtual assets. A lot of banking organizations have had to really start to think much more about how do they monitor the money going in and out of those cryptocurrencies and virtual assets from their accounts. I think there's also, probably don't need to tell this audience, but from a fraud and scams perspective, it's gone absolutely through the roof. So from a fraud perspective, any new scam, any new approach, or trying to really focus on people who are quite vulnerable. So a lot of that is picked up, I guess, in that middle box where I've sort of talked about effects of the pandemic. So criminals are really exploiting opportunities where people are struggling to adapt, looking at vulnerable customers who are not used to digital channels, really taking advantage of them. And that's been a real problem. But I guess also there as well, it's really caused a challenge actually for some of those automated transaction monitoring solutions, because a lot of the first generation solutions, if you like, were really heavily focused towards spotting unusual behavior by having built up a model of what normal behavior is. Well, normal behavior's changed. And so in the early days, none of the models worked very well because normal behavior changed very rapidly. And now it's starting to go back to, if the models are able to evolve and adapt to some element of learning or being based on the data and the actual patterns in the data, they're now able to cope better because we've had more, up to a year of this new normal, if you like. But it was really challenging to start with, and there was a lot of increased volume just at a time where if you get more investigations coming into operations unit at a time you've got more people off sick, that was quite challenging for some organizations to sort of balance and prioritize that. So the ability to be able to really prioritize and focus on risk is really important. And then I guess just on this page as well, David's question was very much about the pandemic, but I just think, other things that are happening in this global world never stay still. So things that are definitely happening at the same time as well, there's still lots more conversations going on about public-private collaboration in this space, how to get the right data coming out of whether it's registries or whatever. There's a renewed focus on green crime typologies around sort of trafficking and various things like that. And there's a real need to embrace and focus on data and data quality, because data drives all of this, and it's the data challenges that have caused some of the pain.
I've never heard that term green crime before.
Oh,
that's interesting. Yeah. Okay, cool. Great. That's fantastic. One more question for you, Heather, before we give you a break and turn things over to Chris. So last question would be, what impact are changes in regulations or regulatory expectations having on the anti-money laundering landscape?
Yeah, so I think a lot of changes in the regulatory expectations have shaped where we've got to today, and they don't ever go away. We'll see ever more iterations of money laundering directives, policy statements and guidance from regulators. So I've tried to sort of, I guess, pick out the themes I see as being most prevalent and the ones that my clients are largely working on right now. And I picked out 4. So the first one is around global consistency. I think historically, financial crime was a bit of a compliance activity where you kept your local regulator happy in a given jurisdiction by putting in whatever controls or checks that they expected. Now you get asked questions like, how can you be confident that you're applying the same risk-based approach in your US business as your UK business? It's just a completely different question. And so the way you need to be set up to be able to answer that is you need to know how your policies, standards and controls are applied across different geographies. And even if you're using slightly different teams, processes or tech, be able to say, actually, they're all aligned to the policy, they're all aligned to the standards, they're all aligned to the risk appetite, and we're confident that we have a consistent way in enforcing our risk appetite across our businesses. And that question is now also getting asked to people in the business. So it's not a question that gets asked of the chief compliance officer. It's going to be the head of the business function who actually is going to need to be ready and able to answer that question, because the regulators want to see the appropriate accountability in the business, and this not just being something that happens in the back office or happens in compliance, for example. And the second one's related to that, so just making sure there's really complete and consistent coverage, particularly in really complex areas where perhaps transactions are quite complicated in terms of the patterns. And so being confident that if you have businesses in really complex product areas like markets, trade finance, correspondent banking, or you've got a small acquired business in an unusual geography, that operates on some different systems, that you've got the right and consistent coverage. So again, when questioned, you can say confidently, yes, we do this everywhere, and it's the same everywhere. Then number 3 is a particular favourite I'm finding in Europe at the moment with some of the regulators, particularly in the Nordics, where they are pretty obsessed around feedback loops. So this is making sure you have the better connection back from what you do from a transactional monitoring perspective into ongoing reviews of the customer. So taking the insight you learn from one control over here that might be a bit siloed from one over here and bringing it back in and making sure the things actually talk to each other and you reuse that internal data. So if you learn something in transaction monitoring that indicates that something may have changed around that customer, triggering that re-review of that customer. And then the final bit is obviously as we start to build models and use analytics and take our more data-driven approach, the other thing that the regulators really care about is explainability. So rules-based systems were nice for regulators in the sense that a rule is quite clear and you write it down and it's specific and it's easy to explain. It's very binary. It's you can explain it easily. Models were likely to include much more numerous data parameters, use the data in different ways. They're a little bit harder to explain. So you need to make sure you've gone through that process internally of making sure they are explainable and they've gone through independent model validation. And then a broader regulatory theme, which goes beyond financial crime, but here where it's really important is to make sure your data lineage is traceable in terms of how the data gets into the models and how the data is being used, so that you can justify the decisions that you're making for your customers.
Fantastic. Was there anything here that you wanted to share with the audience, or saving this for later?
Save that one for later.
Okay. All right. Well, good. Thanks for that, Heather. So you can take a break now. And we'll turn to Chris.
Can't quite take a break. We had a couple of questions from the audience while you were presenting there. So I'll read out first one if you don't mind. So, and I apologize if I mispronounce your name here, but Musi asks, what advice would you give around ransomware and cyber attacks and blockchain fraud? Is that the areas that you cover? Is it a kind of big for your clients?
I think there's a huge fear about ransomware at the moment. We've certainly seen, if we look at the nature of cyber attacks, the areas where we're seeing nature and frequency of cyber attacks increasing are one, around ransomware, and secondly, around attacks that are specifically directed at communication channels. So as a symptom of COVID, what we've seen is that a lot of network traffic has increased because everyone's using much more digital channels. And so there have been some responses to that by some very clever cyber attackers who've tried to then really focus on like Outlook mail servers or other network aspects as a sort of point of attack that will cause a lot of pain and a lot of damage. So those are real areas of focus. Blockchain fraud, I know, is something that has come up in the arena around cryptocurrencies and things like that. There's been in the media even more recently as well. I mean, advice, these are three very complex topics. And I guess my simple advice is to stay on top of the trends, to be very aware and to be very alert. But I think it's also worth recognizing that there is no perfect way to build security that will fully mitigate these risks. These risks will always continue. And this is a part of the life of risk management where you actually have to focus on what will make you resilient. So build the security as best you can. And there's, I have some great colleagues in security, for example, who, another time could come and talk about great techniques in security and things like that. But you should also be planning for resilience. So planning for what you do if someone gets through, and what's your survival plan, and what are you going to do about it, and how are you going to react and respond, because the degree to which you've planned it and you're ready will determine how rapidly you're able to respond and protect your organization from the outcomes of some of these things.
Excellent. And one other one, John asks, how effective are systems that return only exact answers to queries? And in the current day, is it more necessary to have methods that return answers that are close but not exact matches to the query?
Yeah, so the way I would think about this question in a risk concept is that the way that when I talked about sort of moving from rules-based monitoring to more sophisticated monitoring, the challenge with the rule-based monitoring is asks, is this suspicious, yes or no? And it does that based on looking for particular patterns or something passing a certain threshold. And then actually it's then a manual effort to really look into that and determine, okay, well, that's breached the threshold or it's met the pattern that could be suspicious, but then it needs a human to determine whether that unusual activity is indeed suspicious. So the new models that people are creating want to better leverage different data and to create weighted risk scores against a multitude of different data elements or indicators of risk, and then really highlight how that risk score builds up. We can then focus the manual effort on reviewing the cases that have the largest risk scores. I mean, if you're worried about, you getting the right results, you can sample down into other areas periodically, but, from a day-to-day basis, it really helps. And that's where I think about, yes, it's useful to have answers that are close to the query in terms of they exhibit more indicators rather than it being a yes or no answer against a single indicator that then just leads to a lot of noise.
Interesting. Okay, great. Now can Heather have a break, Chris?
I suppose so.
Okay, so let's turn to you. So, the topic of this webinar is fighting financial crimes with graph analytics. So for the benefit of those in the audience who are less familiar with the term graph databases and graph analytics, can you explain what a graph database is?
Yeah, certainly. In short, a graph database is a database that is not built on rows and columns the way a relational database is. It is instead effectively a kind of neural map. What you're looking for when you're running analytics on a graph database, and this actually very much feeds in to Heather's answer for John's question just now, is you're looking at patterns and connections within those various data points. So what a graph database is particularly good at is any kind of use case and financial crime, be it fraud, AML, or know your customer. are particularly useful in this, because you're looking at use cases where you're trying to find patterns which are not easily or readily available for people. So if you're looking at large data sets, very complex connections of data, multiple silo databases, data sources rather, that's where a graph database really comes into play.
Cool.
And graph analytics is the kind of the natural evolution of that. So we often call it graph analytics. People not within the graph world might know it as deep link analytics, but it's all basically the same thing. It's going deeper into the data, going wider into the data, and doing that at an operational level, which is particularly useful when you're dealing with fraud prevention or AML, because you're literally looking at transactional data, and you don't have weeks and months, you don't even really have minutes and seconds to kind of stop it.
Interesting. Good answer. How are graph databases help? How can graph databases, graph analytics help tackle some of the challenges that Heather was talking about in the anti-money laundering field?
Yeah, I think well, if we go on to the next slide, Dave, if you don't mind. So I think where it comes particularly powerful on TigerGraph, and because I am slightly biased towards TigerGraph, we have built some various front-end toolkits specifically for some of these core use cases. So what we're looking at now is some example dashboards that have been built for actual clients to run their AML investigations on. So as Heather said, you're using the graph database to automatically find those patterns, and you're going to put in a rule that says when there's a certain amount of patterns, it goes over to the investigation team to do a deep dive, and there's still that human element. So what these tools sitting on top of TigerGraph do is actually allow the investigator to get more access to more robust data and be able to drill on really quickly and see very clearly where those connections are. So you're identifying fraud rings, you're identifying potential money laundering operations in a very, as you look at that central screenshot, in a very visual manner, which is immediately allowing the investigator to see why this is flagged up. Is there a real danger there? Do I need to investigate further? So it's just saving them an awful lot of time and energy in a way that, you know, if this just came through as a report in a spreadsheet, they really wouldn't have that same level of impact.
Interesting. And then I have to ask, are these systems, this graph database, TigerGraph specifically, they were showing here, intended as a rip and replace for existing systems?
Not at all. And in fact, I honestly don't think we've had a single customer that's done that kind of rip and replace. Instead, they're plugging into their existing systems, and it's about enhancing those, so they're able to get go wider and deeper with the data and get that more depth and more robust insights from them. So it's certainly not about ripping anything out and starting from scratch again at all. It's very much a ecosystem complementary solution.
Mm-hmm. All right, great. Thanks for that. Okay, I think what we'd like to do is actually go back in the deck and do a poll. And hopefully this is going to work. I'm having a few wee challenges with technology today, but let's see if this works. Poll is, which of the following is most characteristic of your AML investigations? Pick all that apply. Too many false positives, too many inconsistencies in output, too much missing information, too much time required to complete. So let's, launch the poll, and let's take a few seconds to get some responses from the audience.
while you're doing that, the three of us will just sit here and stare at you awkwardly.
So it looks like too many false positives is slightly ahead of too much missing information. Too much time to required is coming in third at the moment. And last, and maybe least, is too many inconsistencies in output, but things will change, I'm sure. Let's give it another few seconds. And another 10 seconds or so, and then we'll wrap this up. Okay, that's time to end the poll. So Heather, back to you. Anything that you're seeing here that's surprising? Too many false positives is number one. Too much time required to complete is number two.
That doesn't surprise me at all. I think that was what I was guessing. I was playing like a game in my head and scribbling down like what my predicted outcome would be, and that is exactly what I expected. I think, I talked about it before. Too many false positives come out of the way that people do this today, and because then there's very little insight as to what the true risk is. That's why it takes a long time to complete, because there are some indicators there, but really it puts a lot of time on a person to actually explore and investigate and try and find all the data and try and work out if it's really risky or not.
Okay, Chris. Let's tie this together if we can. How can, first of all, can graph be applied to fighting too many false positives, helping with the amount of time required? If we can help with reduce false positives, are we able to quantify the benefits to that one, or indeed any of these other challenges? Here.
Yeah, and I mean, absolutely. And I'm sure it'll come as a surprise to absolutely no one that I answer positively that TigerGraph can solve these problems. But yeah, I mean, also just to completely agree with Heather, that those were the same sort of levels I was expecting. It's when we're talking to end customers, what they're flagging up is their biggest concerns. So false positives are really absolutely the biggest concern from a commercial standpoint, and I think we all know why. We've all been there where we've had a transaction that's been falsely identified as us not being us, and it's been blocked. And so from a commercial perspective, we all know that our particular bank, credit card, whoever has lost that transaction. And we also all know that if it happens too many times, and too many times can literally just be twice, then that account's getting cancelled, or that credit card's going back into the drawer, never to be used again. So, it's got some huge commercial concerns of that. So that's always one that's really flagged up by a lot of our customers. But we can and do actually run regular POCs, and we're doing direct comparisons of what they're currently doing, and then we run that same data set with TigerGraph. We normally see quite significant drops in those false positives. And the one that always springs to mind for me is one of the big banks in North America. Relatively recently, I think they did this 6 months ago, and have seen a 20% plus drop in false positives. So I think that's significant. That represents a significant commercial impact and customer service impact. From the too much missing information, I don't really think that is an issue that TigerGraph can solve, in the sense that we're not the core data source. But we do live in a world, particularly when it comes to transactions and banking, where a lack of data isn't necessarily a problem. It's getting the insights and finding that golden thread in that data, which is the issue. And that's exactly what TigerGraph's core play is, and it does that automatically. And again, I think if we go back to the slide I last showed with the dashboards, you're looking at how that impacts an investigator. and how it makes it so much easier, simpler for them, and reduces the amount of manual time that the investigation team need to spend in looking at each flagged up instance. Not to mention, obviously, the fact that a drop in false positives means naturally a drop in instances they need to look at anyway, which is obviously more time. So
good point. Good point. So how can graph technology help investigators connect parties, accountants, transactions across disparate data sources? How can graph technology be applied to inform the prioritization or hibernation, escalation, and so forth of work activity, and lead to better decision making in anti-money laundering investigations?
So again, I mean, this is literally a representation of that. So what you're doing is you're connecting TigerGraph up to all your various data sources, and then you're looking for those patterns within all those points of data. Why that's relevant for transactions in the financial space is because of the level of complexity and scale that TigerGraph can deal with. You're dealing with multiple double-digit terabytes of data. You're dealing with what we would say hops, which is from one data source to another, i.e. a transaction of 10, 11, 12, 13 different kind of hops in literally seconds, because it's all automatic. So TigerGraph is able to monitor that throughout the entire flow of that data, if you will, and flag up those patterns. I mean, if we go on to the next slide, this is something that's very specific. I think it might even link into the feedback loops that the Scandinavian nations are so paranoid about. But you're looking there for pattern detection. Very importantly, in something that I'm hesitant to say is unique to graph, but is definitely a very strong point of graph, is ring detection. So what am I mean about that? It's fraud rings, as in networks of people that are working together like a criminal organization effectively to make fraudulent payments or launder money, as it will. And in fact, we can have a real world case of that from one of our clients here in the UK, that using TigerGraph detected basically a pattern of a money laundering ring, which obviously they were able to shut down, but they got the police involved. And further investigation showed that that money laundering ring wasn't just a money laundering ring. It was actually a criminal organization that was involved in human trafficking. So we were able to help the criminal prosecution by showing very clear evidence and they were able to shut down a human trafficking organization that was not only destroying people's lives and committing huge amounts of millions of pounds of crime every year, but they were all able to shut that down, and it ultimately led back to just simply detecting a ring on TigerGraph, which they weren't able to do with their previous solutions. I hope that answers the question.
Well, up to the audience to determine. And again, for the audience, if you have questions for any of us, please submit them. And I think, Chris, there is a question that's come in. Can you?
Yeah, so I've been asked if we can share the algorithms or AI models used to detect that. Actually, we completely can, because although TigerGraph isn't an open source solution, these algorithms actually are. They're also stored on GitHub. They're part of our community. They're open source, and our customers are able to use them from the library, tweak them whenever required. So what I would say is actually also all those toolkits are available as part of TigerGraph Cloud as well. So here's my cheap plug. Get on the website, sign up for a free trial of TigerGraph Cloud, select the toolkits that are most relevant to the customers that you're working with, and have a play around and build some models. And again, like I said, the algorithms are all open source and available through the community.
Fantastic. Okay, thank you for that, Chris. So let's, why don't you take a break, Chris? have a drink of water if necessary, and we'll move to our next poll. For the audience, what is preventing your organization from increased technology investment within your AML programs? Typo there. Pick all that apply. No major inhibitors, insufficient understanding of next generation technology, cost and IT resource limitations, lengthy sales and deployment cycles, or a desire to avoid productivity impact during a transition. So let's see if we can launch poll 2. Here we go. Same typo is in that question here. Interesting. At the moment, cost and IT resource limitations is the biggest factor. By far, it seems. Heather, anything here? Are these sort of in line with what you would have expected to see based on your experiences?
I think so. I think the past year has been one where a lot of costs and energy and funding has been diverted towards react modes and making sure that organizations were able to react and respond to current challenges rapidly, wisely. And as a result, I think many people have felt that their ability to get the sort of funding and support that they have needed to take some of these more strategic initiatives that will derive much higher benefits in the longer term in terms of the overall controls and resilience of the organization and its ability to manage its risk. They've been slightly deprioritized for now, but I do hope that as we get more used to the new normal and we realize it's an ever digital world and actually there's even greater data availability for these tools to allow these tools to be more effective, that those things will start to open up. And also I think as well as we get the more examples, such as the one Chris talked through before, and we start to realize the cost savings that can be made from deployment of some of these new techniques and technologies, people will be able to put together more convincing business cases that are much more self-fulfilling in terms of the benefits that they realize. And I hope that will break through some of the cost concerns in some organizations. I think perhaps from a resource limitation, I guess the other challenge you have with new staff is you don't already necessarily have people on your team with the skills and the understanding to come up with the requirements and support the design for those. But I think that's where you just have to look to work with the right partners and utilize stuff that is out there that's open source, as well as hiring and investing in key skilled people at the right times who can really help you on this journey and make sure you're getting the value back out of it.
I suppose the 43% of people who also cited insufficient understanding of next generation technologies, I would have expected that one to be significant, but maybe not quite as perhaps not quite totaling to 43%. But yeah, I mean, it's something that's new, and to your point, Heather, people are not trained up on anything that's new, almost by definition. So, Chris, anything here that you want to call out in terms of the poll results?
No, I think that's quite in line with what one would expect. The cost and IT resource limitations. I don't think that's really just drawn to this year. I think that's been a challenge in every project I've ever worked on in the last 14 years. So I think it's pretty standard. But obviously now, arguably more than ever. But I actually think it does tie in with quite connectedly with the number 2, which was that insufficient understanding next generation technology. Graph analytics, as a case in point, it is still a very new technology that is on, if you think of the technology kind of trend, the adoption, but still very much at the early stages of that kind of mainstream growth. You're not going to have staff that's hugely experienced in it. Your staff are going to be experienced in the solutions you already have in place, because their job is to run, maintain, and support those. So yeah, I think working with the right partners, such as Accenture, who have the right skill sets, who understand where these new technologies fit in, where they add value, and how to deploy them for the best results is crucial.
Okay, very interesting. Okay, well, at this point, we had planned to pause and do Q and take questions from the audience, and I think there might be another question there. Chris, if you wanted to read that out.
Yeah, well, John's got a valid one, which I don't think we can particularly answer, but he says thinks there should have been an extra option in that poll for there's no commercial platform available that solves the problem I need. And I think in that case, John, you've just came up with your own billion-dollar startup idea. So you know, if you've got a problem that no one can fix, build a solution and make your fortune.
Cool. And you know, for folks in the audience, in addition to John, you know, feel free to ask you questions. This is an opportunity to have experts like Heather and Chris, you know, address your questions. Another question for you, Heather, would be, you know, why should financial services firms take a more data and analytics driven approach to preventing and detecting financial crimes?
Yeah, it's a great question. I mean, to me, there's sort of three key reasons, right? One is to improve your compliance and risk management. If you can harness the value of more data using analytics in order to really gain insight, you can get into those more refined risk scores, and as a result, you'll lead to much better risk and compliance outcomes. That's number one. I think number two is to realize the benefits from a lot of the other digital transformation work that's going on. So I think a lot of digital transformation work that people are investing in at this time is really focused on the customer experience side. If you actually then pull that data through into some of these internal functions, you can then actually really realize additional benefits from those investments. And I think the third one is to drive out efficiencies, get rid of those false positives, get rid of manual effort.
Here's another interesting question. Why is it important, or what is important to get right along the way? Yeah,
great question. So one thing I mentioned before is to remember to design for explainability from the beginning. So you need to be able to explain the outcomes that you come up with, because these will have impacts on how you provide services to those customers, whether you're raising suspicious activity reports, whether you're blocking payments on the basis of fraud, and all these other things. It's got to be explainable. That's absolutely number one consideration. And some people get really excited as they get into the modeling and the machine learning, and they sort of forget about that, and then they have to sort of go back and rework everything. So it's definitely worth remembering from day one, based on what I've seen happen at some of the institutions that I talk to. I think the second one is to try and bring the right team together to execute. Bring a team that has a combination of different skills and experience. You need people who really understand the problem, because you need to create the right hypotheses. You know, using all these wonderful technologies is great, but like, you have to point them at something, and therefore you need the expertise as to what to point it at. And then of course you need the people who really understand how to use the tools and technologies to partner with those people. And we find having those blended teams is super powerful in terms of being able to achieve this and being able to leverage the experience of others within the team. And then I guess my third point is it tends to be a really iterative approach. So this kind of journey that you go on tends to be a really iterative one, tends to be best done in an agile way more than a sort of traditional kind of waterfall type way.
Interesting. Well, Chris, a question, well, perhaps this is for both you, Chris and Heather. A question from Sandeep is, to fight financial crime, would a consortium-driven platform approach work better than individual banks trying to build their own solutions? Who wants to take that one?
Well, I think, would it work better? Absolutely. A consortium approach would always work better than standalone. Is it possible with regulations, commercially sensitive data, regulations such as GDPR and various other kind of regulatory issues for that to happen. I'm not an expert enough to answer it, but I suspect that is the blocker.
So there are some efforts being made around the world into some sort of consortia in this space, but they do suffer a number of the limitations that Chris just outlined. I think where they work really well is to spot patterns in networks, where if you can share the data in a sort of secure and confidential way, and you can then lift out and share patterns that come from it, you obviously gain the real power of that. But yes, I don't think there will ever be, a single database somewhere central in the world that holds all the transactions of all the banks in a way that could be fully explored. I think we're a long way from that, but hopefully, as data privacy technologies and things improve, people will continue their efforts in this space, despite what actually is usually the biggest barriers, politics and barriers to collaboration, and actually make some progress. So some optimism there, but it's not easy.
Okay, well, that's a good note to end on. And if there are no more questions from the audience, and it looks like there are not, let's just move forward and begin to wrap up. So hopefully this has been an interesting webinar. We have another couple of webinars coming up, but just by coincidence are very similar topics. On June 17th, we'll have Experl talking about how to accelerate supply chain planning, and then they'll get into specifics of a actual customer use case. And then on July 8th, Publicis Sapient will talk similar topics, supply chain and logistics management with graph databases and AI. And that's also promising to be very interesting. July 13th, we don't have a title for this webinar yet, but Hewlett-Packard Enterprise will present. And then in August, or on August 2nd, we'll have Xilinx as part of this webinar series. So hopefully you'll tune in for that. If you want to learn more about upcoming graph webinars, then you can go to this URL shown here to do so. With that, I want to thank both of our presenters. Heather, this was phenomenal. I learned a lot, and I think the audience, I'm sure, feel the same way. You conveyed your very deep expertise in this area and shared a ton of very insightful information. So thank you very much for making the time to join us today. We greatly appreciate it.
You're very welcome. Pleasure to be here.
Thank you. And then Chris, also great editorial commentaries. Thank you for sharing information about what graph technologies are and how they can be applied to address some of the challenges and whatnot that Heather articulated. So again, thank you, Chris, for making time to be on the webinar today.
My pleasure.
If anybody would like to reach out to Heather or Chris, you can do so. They're by email. Their email addresses are shown here. No one really needs to know to learn about Accenture, but I just thought I would include that URL on the slides if you did want to learn more, or if you want to learn more about TigerGraph's partner program, PartnerGraph, you can go to that URL. As I mentioned, the slides from this presentation, along with the recording, will be available in a couple of hours. So with that, I think maybe there's one final question. Chris, can you take it?
No, it was just someone from the audience taking their time out to thank us for the webinar.
Oh, that's nice.
They were particularly complimentary about the polls you put in, David.
Oh, okay. All right. Great. I'm glad that was helpful. Okay. Well, that's it. Thanks, everyone, very much. We know that you are busy. We're all very busy, and we're quite touched, frankly, that you took the time out of your day to spend the past, let's see, 54 minutes. And we truly hope that you found it useful. That's it. That's all from us. Thank you very much. And we will see you next time. Bye.
Thanks. Bye.